In 1870, the average black American had about $4 to their name. Not $4 an hour, not $4 a day, $4 total. By 2022, that number had grown to $44,000. On the surface, that sounds like triumph. And in important ways, it is. But that number hides the real story. The distance from $4 to $44,000 was not a straight climb. It was a jagged journey with repeated setbacks spanning more than a century and shaped by specific forces that slowed progress each time it started to accelerate. This documentary follows that journey decade by decade, barrier by barrier, using the numbers, the mechanisms, and the people who lived it. This is the story of how Black Americans built wealth decade by decade and what kept meeting them every time they tried. To understand where this story begins, you need the starting conditions. In 1860, the racial wealth ratio between white and Black Americans was roughly 60-1. For every $60 of wealth a white American held, a Black American held $1. That ratio was distorted by slavery because enslaved people were being counted as property on the white side of the ledger. Emancipation came in 1865. 4.5 million people were freed with almost nothing. The promise of 40 acres and a mule lasted about 6 months before presidential order revoked it. Land that had been distributed to freedmen was returned to former Confederate owners. The starting line in 1865 was not just zero. It was a reset from zero with no tools, no credit, no lasting legal protection, and an economy designed to keep things that way. What happened next became one of the most remarkable economic stories in American history. At the same time, the system trying to stop accumulation was already in motion. Economists who have studied this era say the pace of Black wealth accumulation in those first 35 years was faster than almost anyone predicted. People who had been legally classified as property had become property owners through labor, community savings, and extraordinary discipline in a single generation. By 1900, just 35 years after emancipation, the racial wealth ratio had fallen from 60-1 to 11-1. Black Americans had closed nearly 80% of the gap in a single generation. Black per capita wealth stood at roughly $3,100 in today's money. Black Americans collectively held about 1% of national wealth. That may sound small, but it began from almost nothing against legal systems built to block accumulation. Labor helped drive the progress. So did small farms and community savings institutions. Black women working as farm laborers were earning more than white women in farm labor in this era, and that income was going into land purchases. In counties like Edgecombe, North Carolina, Black landowners had accumulated $5 million in property by 1900, funding their own schools even while paying poll taxes. But the same period also brought a counterforce. Sharecropping was not just a farming arrangement, it was a debt trap with a legal veneer. Farmers borrowed seed and tools at the start of the season, often at interest rates of 40 to 60%. At harvest, the landlord settled the account, and the math usually left the sharecropper owing more than they had earned. Because the debt rolled forward and the contract renewed each year, the farmer stayed bound to the land. The landlord kept most of the crop while the farmer did the work. Consider Celia. She was formerly enslaved in Missouri. She saved $200 from laundry work, bought 40 acres by 1880, then lost it after neighbors burned her barn. She sold the land at a loss, moved north, and started over in a tenement. The 1910s brought the first large wave of the Great Migration. Over 6 million Black Americans would eventually leave the South between 1910 and 1970, and the first wave began here. The logic was simple. A factory job in Detroit or Chicago paid roughly $1 a day, which was real money compared with sharecropping that left almost nothing after debts were settled. The pull was industrial wages. The push was violence and exclusion, lynchings, property destruction, and a legal system that treated black land ownership as a problem to be corrected drove families out. Northern industrial work did offer a step up. Detroit auto plants, Chicago stockyards, Pittsburgh steel, these wages could actually accumulate, but the North was not a promised land. Neighborhoods were already being sorted by race. Unions kept black workers out of the best jobs. Wage ceilings existed in practice, even when they were absent on paper. Back in Mississippi, Isaiah Montgomery had tried another path. He founded Mound Bayou, an entirely black-governed town in the Delta in the 1880s. By 1910, it had $500,000 in assets, its own cotton gins, its own municipal services, and its own economy. White visitors treated it like a curiosity. Then Delta planters moved against it. They boycotted the railroad serving Mound Bayou and blocked supply chains. By 1917, the town was bankrupt. The wealth gap was still closing, but only by about 0.3% per year. Slow. Grinding. The question of where that progress could survive, north or south, was still open. By the early 1920s, a black professional class was beginning to emerge. Harlem was becoming a cultural capital. In Tulsa, Oklahoma, Greenwood showed how far black enterprise could go when it was allowed to grow. 35 blocks of black-owned businesses, law offices, doctors, hotels, a movie theater, and a library made Greenwood known as Black Wall Street. Estimated assets there topped $1.5 million. On the night of May 31st, 1921, a white mob burned it to the ground. Homes, businesses, churches, and hospitals were destroyed. Aircraft were reportedly used to fire on the neighborhood from above. In 18 hours, Greenwood was gone. No insurance paid out. No government restitution came. Survivors stood in ash holding property deeds that were suddenly worthless. That massacre was not isolated. It was the clearest example of a wider pattern. In the Cotton South, the boll weevil was destroying crops, and landlords offered so-called relief seed to help farmers replant. Those advances carried markups of 60% or more. The pest that should have broken the sharecropping trap instead became part of a new version of it. Black farmers who tried to hold on found themselves deeper in debt than before. By the end of the decade, black national wealth share was still about 1%, the same as in 1900. The machine of accumulation kept running, but so did the machine built to stop it. The Great Depression hit every American, but not in the same way. By the mid-1930s, black unemployment was about twice the white rate. In 1935, floods swept through Mississippi and displaced 10,000 black farmers. The Red Cross set up relief tents, and those tents were segregated. Aid was denied to black farmers who could not prove they were not in debt to their landlords, which applied to most of them. Then the New Deal arrived, the biggest government intervention in American economic history. Black Americans were largely written out of it. Social Security excluded domestic workers and agricultural laborers, the two largest categories of black employment. The National Labor Relations Act protected union organizing, but the unions that benefited used that protection to keep black workers out. The Federal Housing Administration helped finance home ownership across the country, but the Home Owners Loan Corporation drew color-coded maps of major American cities. Neighborhoods with significant black populations were outlined in red and marked high risk. Lenders avoided them These were not informal biases. They were official federal documents used by major lenders as underwriting tools. They decided which neighborhoods would build wealth through federally backed mortgages and which would not. The neighborhoods outlined in red in the 1930s are still among the lowest wealth neighborhoods in many American cities today. The New Deal sent billions into white wealth building while shutting black Americans out of the main channels. World War II did not fix the system, but it kicked the door open through sheer demand. The United States needed workers on a scale it had never needed before. Shipyards, munitions plants, and aircraft factories needed bodies immediately. Black Americans were ready. Philip Randolph understood the leverage. In 1941, he announced a march on Washington unless the federal government banned discrimination in defense industry hiring. As head of the Brotherhood of Sleeping Car Porters, he announced in 1941 that 100,000 black Americans would march on Washington unless the president banned discrimination in defense industries. Franklin Roosevelt signed Executive Order 8802. It was the first federal civil rights action since Reconstruction. Black workers poured into the shipyards. At Kaiser Shipyards in California, black welders earned $1.50 an hour. For many families, this was the first wage in their history that allowed real savings, not just higher pay, the first chance to accumulate. Women were in those yards too. Ida May, a composite from shipyard oral histories, organized 500 black women workers and won the first collective bargaining raise in that facility's history. She bought a home before redlining hardened in her neighborhood. Life expectancy rose, home ownership rose, the income gap narrowed in measurable ways. Then the war ended and the GI Bill arrived. It is often described as the greatest wealth-building policy in American history, and for white veterans, that was true. For black veterans, local administrators denied most of the benefits. The Veterans Administration sent them to segregated lenders that would not make loans or would only lend in red-lined neighborhoods. The war had opened a path. The assets that path could have created were sorted by race before the ink on the discharge papers dried. By 1950, the wealth ratio had closed to roughly 7-1. Compared with 60-1 in 1860, that was a real achievement built over 85 years of labor, migration, and survival. The 1950s then created a split that would define the next half century. Income was rising. If you tracked income closely, the gap was closing by about 1.5% a year. But income and wealth are not the same thing. Income is what you earn. Wealth is what you own. Housing segregation was quietly building a two-tier asset market that would shape family wealth for decades. Picture a black steelworker in Pittsburgh and his white co-worker. Same plant, same wage, same hours. The white worker buys a house in a suburb in 1952. The black worker is steered or barred into a neighborhood where black families were allowed to buy. Both men build equity, but the suburb doubles in value by 1970, then doubles again. The red line neighborhood does not. The difference in family wealth by 1980 has nothing to do with discipline or effort. It comes from which side of a government line the house sat on. The mechanism is quiet, but it compounds in property taxes, appraisals, and which neighborhoods get a grocery store and which do not. When both men retire, the same wages have produced very different asset pictures. That divergence, same income and different wealth trajectory, is the foundation of the gap that exists today. Wealth is what accumulates over time. When the asset base is structurally suppressed for a generation, wage growth alone cannot make up the difference. The 1960s changed the law. The Civil Rights Act of 1964, the Voting Rights Act of 1965, and the Fair Housing Act of 1968 were not symbolic. Their economic effects were real and measurable. Black median income moved from about half of white male income in 1960 towards 60% by 1970. The racial wealth gap closed by roughly 1.5% a year across the decade. The fastest sustained convergence convergence in American history. Desegregated workplaces expanded government employment and access to professional careers that had been closed before all pushed the numbers upward, but cities were also burning. Urban rebellions driven by concentrated poverty, decades of disinvestment, and relentless police violence destroyed commercial infrastructure in black neighborhoods across the country. Detroit in 1967, Newark in 1967, many others across the decade. As that happened, white families with the means left cities in large numbers. White flight drained property tax bases where black Americans increasingly lived and worked. White flight accelerated. As black families gained legal access to white neighborhoods, many white families moved farther out, which shrank the tax base of cities. The neighborhoods where black Americans actually lived became less valuable, not more. Black poverty fell below 35% by 1970. Progress was undeniable, but the wealth missed during 30 years of redlining was not returned. Income was catching up, assets were not. The 1970s brought affirmative action into full effect. Black college enrollment tripled from pre-war levels. A strong black professional middle class took shape in law, medicine, government, and academia. Federal employment became one of the most important paths to black wealth accumulation because it offered stable wages, pensions, and job security that private employers were still slow to match. Income convergence that had begun in the 1960s continued, but inflation hit the working poor hardest, and black Americans were still more likely to be in that group. Real wage gains for the middle and upper middle class looked solid on paper. For the bottom half, inflation quietly erased much of what the civil rights era had delivered. Underneath all of this, an asset divide was forming. Black families were building wealth mostly through home ownership, which was the most accessible option available to them. White families were also buying homes, but they were increasingly holding stocks, financial assets, and retirement accounts at much higher rates. In the 1970s, the stock market was not producing spectacular returns, so the difference was still emerging rather than explosive. But the structure was in place. When 1980 arrived, that structure would matter a great deal. By 1980, the structure of the American economy had shifted. The effects would depend on what you owned. In the 1980s, something shifted in how wealth grew in America. Tax policy changes amplified returns on financial assets, and the S&P 500 averaged roughly 12% annually across the decade. If you held stocks, your wealth compounded at 12% a year. Black portfolios in this era were about 67% housing. White portfolios were more stock heavy, with housing closer to 41%. Housing returned about 4% annually. That created a compounding annual gap of about 0.65% in capital gains alone. The difference did not come from one policy aimed at black families. It came from the assets each group held. Black families held housing-heavy portfolios because redlining had restricted their options for decades. Stock ownership was lower because income was less stable. Retirement accounts were less accessible in the industries where black workers were concentrated, and the wealth cushion needed to take risk was thinner. Deindustrialization hit black urban workers hardest in this decade. Factory jobs that had driven income gains since the 1940s were disappearing. Black wages slowed relative to white wages. For the first time since the Civil War and Reconstruction era, the racial wealth gap began widening again. Not because of a single violent event, because wealth was compounding faster in one portfolio than in the other. No law had to pass to make that happen, just compounding in silence year after year. The economic expansion of the 1990s was real. Black median household wealth rose. Poverty fell from above 30% in 1994 toward 25% by 2000. Black homeownership reached historic highs. By absolute measures, the decade was better than the 1980s. But better does not mean equal, and it does not mean the structure had changed. The wealth gap between black and white median households stayed around 6-1. The stock market boom of the decade, the biggest wealth generator of the era, was mainly a white wealth event. Black households participated in equities at lower rates. Credit remained harder and more expensive for borrowers below the median. High-cost debt absorbed income that could have been saved or invested. For households in the bottom quartile, the boom barely registered. The gains were real, but they were uneven within the black community, and they did not move the ratio toward parity. What the 1990s did build was the setup for the next decade. Black homeownership was rising. The home was about to become the target. The 6-1 ratio held. Then came 2008, and the asset black families had concentrated in became the mechanism of the next setback. Black home ownership hit historic highs in the early 2000s, and banks knew it. What followed was one of the most thoroughly documented cases of financial predation in American history. Black borrowers who qualified for prime mortgage rates were steered into subprime loans with much higher interest rates. The pattern was not random, it was systematic. Studies comparing black and white borrowers with identical credit profiles found that black borrowers received subprime loans at far higher rates than their qualifications justified. In practice, a family in Detroit might qualify for a mortgage at 6% and be pushed instead into an 11% subprime loan. The broker earned a bigger commission. The bank packaged the loan into a security. The family paid thousands more each year in interest. Then 2008 hit and housing prices collapsed. Families concentrated in subprime loans. Disproportionately, black and Latino lost homes first and fastest. Black median wealth, which had been rising, fell to about $17,000 at the post-crisis low point in 2013. White median wealth was about $134,000. The ratio widened to nearly 8-1. The neighborhoods most aggressively targeted by subprime lenders in the 2000s were, in most major cities, the same neighborhoods outlined in red on HOLC maps 70 years earlier. The tools changed. The geography did not. White median wealth at the same point was about $134,000. The ratio widened to nearly 8-1, worse than it had been in 1980. Recovery from the floor is not the same as recovery to where you were. The 2010s brought real gains, but they need to be read carefully. By the end of the decade, black per capita wealth was about 7 times its 1950 level and roughly 86 times its 1870 level. Black median income was rising. Black prime age employment reached 78%. Poverty fell below 20% for the first time in modern recorded history. By absolute measures, black economic indicators at the end of the decade were at or near all-time highs. The ratio to white wealth was still about 6-1. That is not a contradiction. It is the central tension of the story. Black wealth was recovering from the subprime crash, but white wealth was also growing from a much larger base, still powered by the stock market that had been running since the 1980s. The housing versus stocks divide remained in place. The compounding advantage remained in place, and algorithmic lending and digital appraisal systems were producing results that looked a lot like HOLC maps once did by hand. The mechanisms had changed. The outcomes had not changed much. Then 2020 arrived, a pandemic, huge policy intervention, a tight labor market, and wage growth at the bottom of the scale that had not been seen in decades. Black workers who are overrepresented in low-wage jobs got their biggest wage bump in modern history. Stimulus payments, an expanded child tax credit, and near record low unemployment produced something the data had not shown before. Black median wealth rose from about $24,000 in 2019 to about $44,000 to $45,000 by 2022, a 44% gain in 3 years. Black poverty fell below 20%. Black unemployment hit a record low of 4.7% in 2023. Black median income reached about $53,000. By every aggregate measure, this was the best Black economic data in American history. But the wealth ratio to white households was still roughly 6 to 1. White median wealth also rose from a much higher base. So the dollar distance between the medians expanded even as the ratio held. Inflation eroded some of the gains. The housing versus stocks divide remained. Projections toward 2026 suggest the gains may continue, but not fast enough to close the gap in the near term. Imagine a family in Atlanta, grandparents who were sharecroppers, parents who became public school teachers, and now a generation that is college educated, homeowner, and wealthier than any before them. Their ratio to white neighbors is still 1 to 6. That is not failure. It is the shape of progress under resistance. Pull back now and look at the full chart from 1870 to 2026. The line is jagged and it climbs. It climbs through sharecropping traps and barn burnings, through Greenwood burning and Mound Bayou collapsing, through a New Deal that redlined the map and a GI Bill administered selectively, through the fastest convergence in American history in the 1960s, and through a quiet portfolio divergence that began in the 1980s. It climbs through a subprime crisis that hit the families who had worked hardest to get into home ownership, and through a pandemic recovery that produced the strongest Black economic data ever recorded. Every inflection point on that chart has a name. Every drop has a mechanism. Every rise has a story of people building against the current. The gap today is not mysterious, and it is not about character. It has a paper trail, sharecropping contracts, HOLC maps, New Deal exclusions, GI Bill records, redlining boundaries, subprime steering documents, and algorithmic appraisal outputs trained on historical data. The paper trail runs from 1865 to today, so do the gains.